Okay, let's understand what are the different objectives of investment. So here we have classified the objectives of investment into two broader categories. First is your main objectives, second is your subsidiary objectives. Let's see what are the main objectives. Main objectives of investment is to maximize the return and minimize the risk. Now let's see what are the subsidiary objectives. First is your maintaining liquidity. Second is your hedging against inflation. Third is your increasing safety. Fourth is your saving tax. Now let's see each one of them one by one. Let's go to the maximizing the return. What do we mean by maximizing the return? So any investor would look for a good rate of return for the investments they are making. That's one of the purpose why they are making this investment. So how do we calculate rate of return for any investor? We calculate it by using this formula which says rate of return or return is equal to value at the end of the period minus value of the investment at the beginning of the period plus dividend. That's one kind of income which you invest in securities divided by value at the beginning of the period into 100. This will give you rate of return or return percentage. Secondly, we will see minimizing risk. So risk of holding security is probability of the actual return being less than the expected return. Let's say if your actual return becomes less than your expected return, basically what we are talking about is risk. So investors would like to reduce risk by proper combination of different securities. Let's say if telecom sector is not doing well and I have made some investments into telecom sector, so I can go for a different combination where I can invest into FMCG sector and IT sector along with the telecom sector. So my risk is equally distributed among different sectors. So this is one of the way through which you can reduce your risk. Now let's go ahead and see what are the subsidiary objectives. The first one is maintaining liquidity. If you invest into equities or if you invest into recurring deposits, so right from recurring deposits to equities, there are different asset classes which provides you enough liquidity. In case you need money, you can encash this investment and meet your immediate obligation. Liquidity determines the ease, time and cost involved in converting the investment into cash. Liquidity depends on marketing and trading facilities. Now, hedging against inflation is one of the subsidiary objectives. So, saving is basically the money that you have kept from your income. But that saving is of no use if you are not putting it into a proper investment. The reason is that we all know that the value of money today is more than the value of money tomorrow. That means if you are not making a proper investment, basically you are losing the value of the money if you have just kept it as a saving. So rate of return should cover against inflation to protect against the rise in prices and fall in the purchasing value of money. That's exactly what we learn from time value of money. In this course, we are also going to do a refreshing session about time value of money, which will make this idea much clearer to you. Rate of return should be higher than rate of inflation to protect investors from experiencing loss in real terms. Increasing safety, the investment also provides you with the objective of increasing safety. Each investment option is affected by risk. The selected investment avenue or asset class should be governed by legal framework to increase safety of investment. Investment made with government assurance are more safe than a private party. Though we are making the investment even with the private party, government has constituted certain bodies which gives us the assurance that our investment is safe against any kind of fraud or corruption. For example, we have got AMFI for mutual funds, that's the government body which looks after the mutual fund investments. We also have SEBI for secondary market or stock exchanges, which is basically Security and Exchange Board of India. So these are the government bodies which basically looks after your investment against fraud or against corruption kind of risk. Saving tax. Now there are certain investment avenues which provides you with the bonus of tax saving. This actually boosts your saving and hence boosts your investment. For example, we have certain mutual funds which can be considered under tax deduction from the income tax department, or there are certain insurance products which comes under saving tax schemes initiated by the government. Certain investment offer tax incentives. Investors try to minimize the tax outflow and maximize the tax returns. In next slide, we are going to see what are the different types of investment.